Have you ever wondered why ratio analysis is so crucial in the world of finance? Well, it's because it's a powerful tool that helps to gauge a company's performance and financial health by comparing different financial metrics. Imagine you're a detective and you're trying to solve a case. You gather all the evidence, scrutinize it, and then draw conclusions. That's essentially what ratio analysis is. It is a method of examining and interpreting the numbers to understand the health of a business. Ratio analysis can provide significant insights into a company's operations and future growth. It's like having a crystal ball that allows you to peek into the company's financial future. But it's not just about predicting the future. It's about understanding the present and making informed decisions. So stick around as we delve deeper into the world of ratio analysis. It's time to put on your detective hat and start unraveling the mysteries of finance. To comprehend ratio analysis, it's essential to grasp its purpose and how it works. So let's dive right in. Ratio analysis, at its core, is a method of financial statement analysis that uses various ratios to gain insight into a company's financial health and performance. Now, you might be wondering, what do we mean by ratios? In the world of finance, a ratio is essentially a comparative figure that shows the relationship between two or more financial data points. These data points are typically pulled from a company's balance sheet, income statement, or cash flow statement. For instance, imagine you're looking at a balance sheet. You see two numbers: total assets and total liabilities. By dividing the total liabilities by the total assets, you get a ratio that tells you what proportion of the company's assets are financed by its debts. This is just one example of many ratios that can be calculated. Ratio analysis doesn't stop at just one company, though. It's also a powerful tool for comparing the performance of different companies, particularly those within the same industry. By comparing these ratios, one can understand how well a company is doing relative to its peers. This can be incredibly useful for investors, creditors, and even the companies themselves as they strategize for the future. And while it may seem complex, once you get the hang of it, ratio analysis can become second nature. You see, it's all about understanding the relationship between different pieces of financial data and using that understanding to make informed decisions. This isn't to say ratio analysis is the be-all and end-all of financial analysis. Like any tool, it has its strengths and weaknesses. However, when used correctly and in conjunction with other methods, it can provide valuable insights. Now that we've got the basics down, let's move on to the different types of ratios in ratio analysis. There are several types of ratios used in ratio analysis, each offering unique insights into a company's financial health. One of the most commonly used ratios is the liquidity ratio. As the name suggests, liquidity ratios measure a company's ability to meet its short-term obligations. They are a good indicator of the firm's financial stability. Two key examples of liquidity ratios are the current ratio, which compares current assets to current liabilities, and the quick ratio, which is a more stringent measure as it excludes inventory from current assets. Next up, we have profitability ratios. They provide an insight into a company's ability to generate profits in relation to its size, assets, or the equity it has. Examples include the net profit margin, which shows how much of each dollar of revenue is left over as profit after all expenses, and the return on equity, which measures how effectively management is using a company's assets to create profits. Solvency ratios, on the other hand, focus on a company's long-term stability, specifically its ability to meet long-term obligations. Debt ratio and equity ratio are two examples of solvency ratios. They provide information about the company's debt levels and equity position, respectively. Efficiency ratios are another important type. These ratios measure how well a company is utilizing its resources. They include ratios like inventory turnover, which indicates how quickly a company sells its inventory, and asset turnover, which measures how effectively a company is using its assets to generate sales. Finally, we have market prospect ratios. These ratios are used to assess a company's future prospects and are often of interest to investors. They include price-to-earnings ratio, which compares a company's current share price to its earnings per share, and dividend yield, which shows the return a company gives back to investors in the form of dividends. Understanding these ratios can provide a wealth of information about a company, but how exactly do we interpret these ratios? Let's explore that in our next segment. Interpreting ratios can seem challenging, but don't worry, it's easier than you think. Welcome back to the final chapter of our journey into ratio analysis. Now that we understand what ratios are and the different types, let's dive into how to interpret them. Think of ratios as a financial magnifying glass, giving you a closer look at the inner workings of a company. To start, let's take a look at profitability ratios. If a company's return on equity is higher than its competitors, it indicates that the company is generating more profit for each dollar of equity. But remember, a high ratio is not always a good thing, as it could also indicate higher risk. Now let's think about liquidity ratios. A high current ratio, for instance, means that the company has more assets than liabilities. This is generally a good sign, indicating that the company can pay off its short-term obligations. But again, a very high ratio might mean that the company isn't using its assets efficiently. Comparing these ratios to industry averages is a great way to gain insights. If a company's ratios are significantly different from the industry average, it may indicate a unique strategy, or it could be a red flag. Another way to interpret ratios is by comparing them to the company's past performance. Is the company's debt ratio increasing over time? This could mean that the company is taking on more debt, which could be a cause for concern. But remember, ratio analysis has its limitations. It's based on historical data, which may not always predict future performance. Also, ratios can be manipulated to some extent by creative accounting practices. Therefore, it's important to use ratio analysis as one of many tools in your financial toolkit. And there you have it, ratio analysis, a powerful tool in finance, offering insights into a company's financial health and performance. Remember, understanding ratio analysis is like having a financial magnifying glass that gives you a closer look at a company's operations and growth potential.